Welcome, everyone, and we're glad you're joining us for today's webinar, 3 little known facts that every TSP participant should know. My name is Greg, and I'm joined with my colleagues Tara and J.A., and we are with Atlantic Wealth Management located in Morehead City. And it's our pleasure to talk with you for a few minutes today. We're excited to get started, so let's begin.
All right, so before we start our presentation, keep in mind that today's webinar is for educational and informational purposes only. Before you take action, we do recommend that you speak with your tax advisor, your attorney, and also your financial advisor.
So let's begin. We thought where Morehead City is located, right between several military installations, that we hear a lot from military and federal employed participants of the TSP, specifically when it comes to retirement and planning for retirement. And so we thought we'd address some questions and go forward, just talking about federal service and the thrift savings plan. So Jay, you want to take us through that before retirement and after retirement?
Sure, be glad to. So probably most of you are watching because you have been a federal employee or you are now still currently. Yeah. And so some of these things that I'm about to go over hopefully are familiar to you, but during federal service, so while you're still working, obviously you can make contributions through payroll deduction to the TSP plan. You are able to make rollovers. So if you have other qualified plans, retirement plans or IRA accounts, you can roll them into TSP plan, just not Roth IRAs. You do manage the account yourself, so you probably have a login where you can go online and check to see your balance, but also it allows you to make changes to your allocation, which means you have the ability to move assets from fund to fund. And then you can also do that with your contributions. So not just the balance that you've got in TSP, but your ongoing contributions, you can make changes to how those are being invested in the funds. Correct. In terms of loans, while you are an active federal employee, you can take general purpose loans out from your TSP plan, and you can take first-time home buyer loans.
That's a good benefit.
Yeah. And repayment terms for those, general purpose, 1 to 5 years, first-time home buyer, 1 to 15 years.
So what about after federal service? Just wanted to briefly touch on a few options that you have or things to consider after federal service, and then we'll touch on these with some more specifics.
We'll go into a little bit more of that as well as we move forward.
Yes, so first of all, you can leave funds in the TSP plan. Rollovers are still allowed into the plan from outside qualified plans and accounts, just not Roth accounts. You could roll over funds, transfer funds out of the TSP into either another employer retirement plan, a qualified plan, or an IRA account. And so some folks may be thinking, hey, I don't care to manage this myself in retirement, and maybe looking to do that and obtain management elsewhere.
Yeah, we see that often.
And then withdrawing funds, some folks keep funds in the TSP and start a withdrawal process of those funds, whether it be on a systematic, planned basis or on an as-needed basis. It is important, though, just to consider the tax consequences when you start looking at taking withdrawals.
All right, it's time for a pop quiz. So we wanted to test your knowledge on the thrift savings plan, and specifically about how many investment fund choices there are in the TSP. So get ready. You guys will have a chance to submit your answers. Is it A, 5, B, 8, C, 10, or D, 15? So submit your answers and stay tuned for the answer in just a little bit.
Yeah, we'll review that. Okay, so here's our agenda for today. Like Greg said, 3 little known facts that every TSP participant needs to know. First is what happens with the savings plan at military or federal retirement, and we want to go through what your options are. Secondly, we're going to talk about Roth TSP, what are called required minimum distributions, and some little known facts about those as well. And then last, we're going to talk about the Bailey Act and if your Bailey Act applicable.
All right, so let's start with TSP at military and federal retirement.
Okay.
So this is about what you need to know as you approach your transition to
Right.
retirement.
Mhm.
And it could also be if you've already retired too,
Sure.
I think. And you're a participant in the thrift savings plan.
Okay, so option one is to leave funds in the TSP.
Mhm.
Again, we briefly touched on this a minute ago, and bringing you guys back to the pop quiz question, the answer is in these first two bullet points here in the first box. 5 plus 10 is
15.
15.
Yeah.
So there's 15 investment options in the TSP plan, 5 core funds and 10 life cycle funds.
So the 5 core funds, let's review those really quickly. G, F, C, S, and I.
That's correct. Yep. And then the life cycle funds are kind of based on a target date of
Right.
retirement for
Mhm.
folks. There are interfund transfers that are allowed. So if you keep your money in the TSP plan, you can change up your allocation and move from fund to fund.
Yep.
And then contribution allocation changes. So if you were to roll in money from
Mhm.
outside plans into the TSP, that would be allocated based on your contribution
Right.
allocation.
And one thing to note, just going one bullet point up, the interfund transfers. While in TSP, you can interfund transfer 2 times per calendar month into any of the funds that you want. Third time and after within that month can only go back to the G fund.
Didn't used to always be like that. There was a lot of transfers going on. Years
Yeah,
ago.
I'm pretty
right.
sure that's why they put those limits in place. Yeah.
Something else to note is if you keep funds in the TSP plan, you do have to have spousal consent
Yeah.
to make a withdrawal. So
Mhm.
that can present, another step to walk through
Right.
if you needed to take a withdrawal. It is important to make sure that you have your beneficiary designations the way you want them and that you have designated a beneficiary on the TSP plan. So that can be done through the TSP 3 form. And it's also important to note that spousal beneficiaries are able to maintain an account with TSP.
Correct.
So
Yeah.
if your husband or wife was a federal employee, had a TSP plan, they passed away, you could then have an account in your name with TSP.
Mhm.
And then finally, you do have to start taking withdrawals at age 72 with money in the TSP plan.
Okay, option number 2, when we're talking about rollovers, if you're going to do a rollover, which means that TSP would send the money to you and then you would be responsible within 60 days to complete that rollover into a qualified plan. If that doesn't happen, there are tax consequences to include a 10% early withdrawal penalty if you're not of age to take withdrawals. And so the IRS defines that age right now as 59 and a half. We do recommend transfers. So what transfers are, meaning that you're going to take the money from account to account. So rolling out of TSP or transferring out of TSP would be the money going directly into the qualified account. A benefit of transferring that money to something like an IRA would be professional management and you having those assets managed for you. JA mentioned the required minimum distributions. So that's at age 72. If your money remains in through a savings plan, you're going to be required to take money out of the account, whether it's traditional or Roth, and we'll get into some details in just a moment. But if you want to avoid that, one option is to transfer money out of TSP. If it goes into a Roth IRA, you don't have to take required minimum distributions from a Roth IRA. For consolidation, it's always a good idea to organize and make your accounts more efficient. And so by rolling money out, consolidating those accounts, that might be beneficial to you.
Sometimes that helps too with lowering the fee.
Absolutely. And I think it gives just participants, well, it's given our clients the ability to look at all of their assets and all of their accounts together at once, which they may have never done before.
Good point.
For conversions, if you'd ever want to convert a traditional balance to a Roth balance, that's not authorized within the thrift savings plan right now. So you would need to roll funds out and then do that conversion. Okay, there we go. Option number 3 is to withdraw funds, age-based withdrawals. Remember what I talked about before, being age 59 and a half. At that age, you can take installment payments, so something like a monthly distribution. You can take single withdrawals, so if you have some expenses that are higher than you were thinking, you can request for that single withdrawal, or an annuity purchase. Keeping in mind with taxes, if you are not age 59 and a half, there's that early withdrawal penalty. But taxes on retirement accounts, specifically traditional balances, you do have to pay ordinary income rates. Like I mentioned before, some exceptions to the early withdrawals are death, disability. There is something called the age 55 rule. So if you separate from federal service after age 55, you can start to take money out of your thrift savings plan without having to pay that early withdrawal penalty. SCE employees actually can do that at age 50. And then we have something called 72T distributions.
Okay, so option 4 is a combination of what we just went through in the first 3 options. This could be leaving funds in the TSP, but also rolling some out. You have to have a minimum balance of at least $200 in the thrift savings plan to remain a participant. It could be where a client would want to roll some of the money out, do a conversion on those funds into after-tax money in a Roth IRA, but still participate in the thrift savings plan with the lower fees and whatnot that way.
Yeah.
It's important to remember too, that sometimes clients would make a transfer out of most of their money because they want to take withdrawals. And if they're a married first participant, they would have to get that withdrawal form signed and notarized by their spouse. So just to eliminate some of that hassle, they've decided to move those funds out.
Correct.
Again, professional management, the things we've already talked about. Also, it's important to remember you can move money into the TSP. So for participants that have separated from service, they want to retain that opportunity to move money back into the thrift savings plan.
Right.
As long as they keep $200, they'd be able to do that. Now, keep in mind, as Jay said, you cannot borrow money once you separated from service. So that, that option is off the table.
Yeah.
So those are some combination options there to think about. Also, keep in mind, if you have a loan and you separate from service, you've got 90 days to pay it back. Otherwise, it becomes taxable income to you. So you want to make sure you pay that loan back.
Absolutely.
All right, that brings us to little known fact number 2,
Right.
which is that TSP Roth, if you have TSP Roth funds and that's applicable to you, then there are required minimum distributions, which means you will have to take money out at some point.
Okay, let's take a poll. How about it?
Okay, sounds good.
So we'd like to poll our audience and find out how many of you have Roth money in your thrift savings plan. Take a quick minute on your screen there and just note it. And we'd like to tally those up just for our own information.
Okay, so with required minimum distributions, like JA said, there comes an age in which you're going to have to take money out of certain retirement accounts. So little known fact number 2 is Roth TSP, similar to a Roth 401k, if money is left in that account, does have required minimum distributions. There's often confusion between that type of account and a Roth IRA, in which it does not have required minimum distribution. So a few things that we want you to know. For withdrawing, it is required at age 72. It's based on the account balance and age, and JA in just a moment is going to go through an example for us. Also keep in mind that if you have other accounts like traditional IRAs, or other 401ks that have required minimum just distributions, they're not aggregated. So you'll need to make sure that you take the required amount from each of those. As far as taxes, remember ordinary income tax rates, not capital gains rates. If you want to avoid the RMDs, if you have a Roth TSP balance, you can transfer that to a Roth IRA. And then from there, remember, no required minimum distributions. And then the Roth conversion. So what that would look like is traditional money in the thrift savings plan would be transferred to a traditional IRA, and then we would do the conversion from there. It doesn't have to be all at once. So we have some clients who, would roll out a portion and then do that conversion. Something back to what Greg was mentioning before with the Roth conversions is by keeping money in TSP, we have the ability to go backwards as well. And so in order to do the Roth conversion, we can't have extra money in a traditional IRA that we're not going to convert. There's something called the pro rata rule. So maintaining at least that minimum balance in TSP allows us to go back, which I think is a really helpful benefit.
Yeah, and I don't know how many people really know about the Roth RMD, the requirement in the TSP.
Most people that we come in contact with that I've spoken to, they really think that the Roth TSP and Roth 401k rules follow the same as the Roth IRA. Yep.
That could be a really big surprise. Yeah,
that's right. One question people have is, so I know I've got to take money out at age 72, but how much do I have to take out?
right.
What is my RMD going to be? And we just kind of to model that out or to give you an example and an idea of what that looks like. We've put down here and made some assumptions about a TSP plan participant age 72 that's accumulated $1 million in his or her TSP plan.
Okay, that's good.
The RMD at that point would be just a little over $39,000.
Okay.
So that's a significant amount. It's between 3.5% and 4% of the account balance. And under this, you can see how that walks out over a 10-year or so time horizon. The RMD goes up each year, assuming that your account continues to grow and have earnings. So that's 39,000 as a starting point. Oftentimes folks, may not need the income that the IRS comes in and says you have to take.
Yeah, especially if they have a pension and other income.
That's right. You have to factor in, their overall situation. But that presents some planning opportunities for us to have conversations with folks around.
Yeah.
Whether that be reinvesting funds, excess funds that they have to take out.
Right.
For folks that are charitably inclined, we run into this a lot.
That's a big one.
Folks that want to give to their church or other charitable organization, they're able to do that via qualified charitable distribution.
Right.
And it benefits you from a tax standpoint and allows you to accomplish your giving goals at the same time.
And it keeps the income off your taxes.
That's right. That's right. And then sometimes risk management is applicable, or legacy goals are applicable to folks. And if there's, excess income that has to be taken out via RMDs, but maybe there's intent or desire to leave a big gift to kids, grandkids, or to a charitable organization, we can use life insurance to do that. So it can be a funding mechanism, the RMDs for life insurance.
And of course, life insurance passes tax-free.
That's right. So the benefit to that.
All right, the third little known fact that we'd like to go over with you, just take a brief minute to talk about, is the Bailey Act. J.A., can you share the details or at least an overview of the Bailey Act?
Yeah, I'd be glad to. And I wish I was a TSP plan participant who was applicable to the Bailey Act. So the Bailey Act was pursuant to a court proceeding. It went into effect in 1998. But for those that fall under the Bailey Act, basically the benefit is you do not have to pay any state income taxes on distributions from TSP plan.
Right.
You guys know the state income tax rate?
5 1/4.
5.25%. So that's a significant savings.
Can be, yeah.
Okay.
5.25%. So am I Bailey Act applicable is probably your question. And so there one of two qualifications that you have to
Sure.
fit under for that. The first is the bullet point there, 5 or more years of creditable service prior to August 12th of 1989.
Okay.
So if you check that box off, good for you.
Yeah.
The second would be if you started contributing to the TSP plan before that same day, on or before August 12th of 1989.
Mhm.
So hopefully many of you sitting out there are realizing for the first time you're Bailey Act
Yes.
applicable and
Yeah.
have some savings to look forward to.
That's
in
a good
terms of-
thing.
in terms of taxes.
Yeah.
One of the things also that's important to note, if you raise your hand and say, I am Bailey Act applicable, great. That benefit also applies to survivor
Survivors.
benefits. Terry, you were.
Yeah, I was
sharing.
just thinking about an example. If my husband were to qualify due to his military service, he were to pass away, I would then be Bailey Act applicable and be able to avoid those state taxes. Yep.
So huge benefit. And then the final bullet point there is just, you do have to claim that deduction on your North Carolina returns. You have to be sure not to report that income if you are Bailey Act applicable.
Okay, so at this time, I want to give credit where credit is due. We do get our information directly from the source, so any tax information that we've shared comes from the IRS. The TSP specifics comes from tsp.gov, and then of course, information on the Bailey Act and North Carolina state taxes comes from North Carolina Department of Revenue. So at this time, what I want to do is I've seen a few questions come in. I think Greg has somewhat addressed one of them before, but I want to make sure that our audience knows the answer. So the first question is going to be, if I have a loan with their savings plan and I separate from federal service, how long do I have to repay it back?
Yeah, so
Yeah.
we did talk about this. It's 90 days.
Okay.
And if you don't pay it back within that time, it does become taxable income to you.
Mhm.
So make sure you pay off
Right.
the loan.
Definite some tax consequences there if you don't pay it back. Okay. Next question is, if I pass away and my children are beneficiaries, will they be able to maintain my TSP account? So I'm gonna send that one to
Toss that
JA.
to me.
Yeah.
So if you are a non-spouse beneficiary, a
Mhm.
child beneficiary,
Correct.
you cannot maintain a TSP account.
Mhm.
Unlike with a spousal
Spouse.
beneficiary,
Yeah.
who can keep the account there at TSP. Hey, something else I was thinking about
Okay.
that's come up recently in our conversations has been the impact or the recent legislation that's been in the pipeline in the North
Mhm.
Carolina state legislature
Mhm.
about retirement benefits
Mhm.
for veteran
Correct.
employees.
Yeah, that's huge.
Mhm.
Yeah.
Right.
One of you guys want to address that? Give everyone an update on where we stand on that.
Right. So at this time, I believe it has passed the House, right? Am I correct? And now moving on to the Senate. But the proposal is for military retirement to not be taxed by the state of North Carolina. So we really think that that's a positive move and definitely would attract retirees to come visit us,
Yeah.
come live in our state. Yeah.
It'd be almost the equivalent of the Bailey Act, right? Or similar.
Mhm.
Similar,
Absolutely. On the
situation.
pension amount,
That's right.
that'd be great.
All right, so that kind of brings us to a conclusion of the information presenting for this webinar. So we talked about some important things to be aware of and to make note of. But what we do here at Atlantic Wealth is to go beyond just what you should know, to really look at your specific situation and how we can help you plan
Mhm.
and make good decisions, smart financial decisions about the future. And so we'd like to extend that opportunity to each of you that are attending and watching this webinar. If
Absolutely.
there's a chance or an opportunity for us to have a phone conversation or to sit down in person, face to face, have a Zoom call, just to talk through your situation and see how we may be able to help, we'd like to extend that offer to you. And so what does it look like to work with us at Atlantic Wealth? What does the client experience look like?
Mhm.
Just wanted to touch on that briefly and talk about a few things on this last slide here.
Okay.
our approach here is a comprehensive approach
Yeah.
to wealth management. So we're not just looking at one account that we're managing. We're looking at your
Everything,
situation
yeah.
overall. It's based on your objectives and what's important to you.
Usually starts with that question too, doesn't it?
That's exactly
We
right.
call it holistic.
That's right.
Yeah.
We are focused intently just on treating our clients, like their family. And so exceptional customer service. We've had conversations with clients. This is what we would advise our parents to do,
Right.
Or our, brothers or sisters,
Mhm.
if they came to us and were asking for our advice. It is financial management that we're focused on results, what Greg said, that's based around what's important to you and your situation. So we start out with that question, what is important to you? That's the first thing we want to understand. And then everything else would flow from that. What are the things you like to do? What does retirement look like? If you're in retirement, what does that look like? What do you want it to look like? We try to zero in on those goals and those things that are important, and then help you map out a plan to get there. Ongoing performance and account monitoring. So we don't just sign paperwork and then never talk to you again, but
Right.
this is a process. As a client of ours, that we would be in continual communication with you. We'd want you to pick up the phone and call us when things change in your situation, so we can stay abreast of those things and stay updated. And we'll reach out to you about setting regular review meetings and keeping you updated on how things are going.
We really want to see clients reach their goals.
That's right. Definitely. Number 5 there is just a consultative full balance sheet approach. So again, we're looking at everything overall. Risk management and cash flow planning can be important for folks too. So maybe there's a need for life insurance or long-term care, risk management planning, and we're able to sit down with folks and talk through options and alternatives for that too. Right. And then coordinating with other professionals depending on the needs. So with big transitions in folks' lives, oftentimes there's a need for an attorney to come in and offer advice and feedback and be involved, maybe a CPA or an accountant, and then a financial professional. So what we like to do is work in tandem with those other professionals so that we're coming alongside you guys or our clients and able to provide the best advice and comprehensive advice.
Well, I believe that's all for today. We thank you for joining us for today's webinar on the TSP. We hope you found it useful. And our desire is to be your trusted financial resource. And we believe our team approach allows us to provide the highest level of personal service that would enable you to meet your goals and have positive outcomes. So we look forward to hearing from you. If there's a way we can help, please let us know. Just give us an email. There's some information, contact information on how to get in touch with us. We'd love to hear from you and we'd love to help you. Have a great day. We'll see you next time.